For years, the Carolinas were marketed as the safe escape. Affordable suburbs, booming job markets, in-migration from Florida, New York, and California. On paper, North Carolina and South Carolina looked bulletproof. But 2026 is exposing the cracks. Across both states, suburban housing markets that exploded during the pandemic boom are now reversing fast. Inventory is piling up. Price cuts are becoming routine. Builders are offering incentives they swore they'd never need again. And in certain suburbs, the math no longer works at all. Here's the problem most people missed. The Carolinas didn't just grow. They overexpanded. Entire suburbs were built on cheap credit, out-of-state buyers, and the assumption that migration would never slow. But when interest rates stayed high, layoffs spread through tech and finance, and insurance and property taxes crept up, demand pulled back hard. These suburbs weren't designed for stagnation. Many rely on a single employer, a narrow job sector, or commuters who suddenly don't need to live there anymore. Others are dominated by new construction with little resale history, meaning when prices fall, there's no floor. Once sellers start undercutting each other, declines accelerate. Another factor, investor saturation. Short-term rentals, single-family rentals, and speculative buyers rushed into Carolina suburbs chasing the next Austin or the next Tampa. Now cash flow is tightening, rents are flattening, and investors are exiting. When investors sell all at once, suburbs feel it first. This video breaks down 10 Carolina suburbs, not big cities, not downtown cores, but the places where housing stress shows up early. These are areas where prices ran far ahead of incomes, where infrastructure lagged growth, and where the exit doors are starting to feel crowded. Watch through the full list, because some of these suburbs are still being marketed as hot. Others are already quietly correcting. And a few? They're facing the kind of housing crash that no one saw coming, until it was already underway. Before we get into suburb number 1, hit like, subscribe, and share this video. If you live in the Carolinas, are thinking of buying, or already own property here, this is information you cannot afford to miss. 1. Matthews, North Carolina, Charlotte suburb. Matthews was marketed as one of Charlotte's safest bets. Quiet streets, good schools, and proximity to banking jobs made it a magnet for families and out-of-state buyers. During the boom, prices surged fast, and that speed is now the problem. The first crack is price-to-income mismatch. Home values in Matthews jumped far faster than local wages. Many buyers stretched using low interest rates and aggressive assumptions. In 2026, with rates still elevated, that buyer pool has thinned dramatically. Homes sit longer. Price cuts are no longer rare. They're expected. The second issue is commuter dependency. Matthews relies heavily on Charlotte's white-collar job market, particularly finance and professional services. When hiring slows or layoffs ripple through banking and fintech, suburbs like Matthews feel it first. Demand doesn't vanish, but it pauses, and housing markets hate pauses. Inventory is another pressure point. Newer developments expanded rapidly on the assumption that in-migration would continue indefinitely. That assumption is now shaky. Builders are offering incentives. Resale sellers are undercutting each other. When new construction competes with resale, prices soften fast. Property taxes and insurance quietly add fuel. As valuations climbed, tax bills followed. Insurance premiums rose as replacement costs increased. For households already stretched, the monthly math stopped working. Some list, not because they want to move, but because they have to. Investors are pulling back too. Single-family rentals that penciled out in 2021 don't work the same in 2026. Rents have flattened, while expenses haven't. When investors exit suburban markets, liquidity dries up quickly. Matthews isn't collapsing in dramatic fashion. It's sliding. And in housing, slow slides are dangerous because sellers don't panic all at once. They trickle out, compounding price pressure over time. 2. Garner, North Carolina, Raleigh suburb. Garner was one of the fastest-growing suburbs outside Raleigh, and that growth came with a warning label most people ignored. It was built on affordability, but affordability vanished. Home prices in Garner surged as Raleigh tech growth spilled outward. Remote workers and first-time buyers flooded in, pushing values well beyond what local incomes support. When rates rose and tech hiring cooled, demand pulled back hard. The biggest issue? Over-concentration of new construction. Entire neighborhoods were built within a narrow time window. That means resale homes now compete directly with brand new inventory. Builders can offer rate buy-downs and incentives. Individual sellers can't. Another pressure point is job sensitivity. Garner depends heavily on Raleigh's tech and research economy. When layoffs or hiring freezes hit, Suburban demand weakens first. Buyers wait. Listings pile up. Prices adjust downward quietly, one cut at a time. Infrastructure strain matters here too. Rapid population growth stressed roads, schools, and utilities. Commutes lengthened. Property taxes increased to fund expansion. These costs aren't visible in listing photos, but buyers feel them monthly. Investor activity amplified volatility. Many buyers treated Garner as a growth play, not a long-term home. As appreciation slowed, exits began. That adds supply fast, especially in newer subdivisions where layouts and floor plans are nearly identical. Garner isn't failing because it's undesirable. It's failing because it grew too fast on fragile assumptions. When affordability disappears and growth pauses, suburbs like this don't plateau, they correct. In 2026, Garner is a textbook example of how a hot suburb becomes vulnerable once the migration math changes. 3. Rock Hill, South Carolina, Charlotte Metro. Rock Hill sold itself as the cheaper Charlotte alternative. Lower taxes, new developments, easy commute. For a while, that pitch worked extremely well. Too well. Prices in Rock Hill surged as North Carolina buyers crossed the state line chasing affordability. The problem is that wages in Rock Hill never caught up. By 2026, the gap between what homes cost and what residents earn has become one of the widest in the region. This suburb is hyper-dependent on Charlotte's job market. Finance, logistics, and corporate services drive demand. When those sectors slow even slightly, Rock Hill feels it immediately. Buyers hesitate. Sellers list. Inventory rises. New construction is another stress point. Builders raced to meet demand, flooding the market with similar floor plans. When demand cooled, competition intensified. Price cuts started quietly, then spread. Incentives became standard. Taxes and insurance compound the issue. Property taxes rose as valuations climbed. Insurance costs followed replacement values. The total monthly payment shocked buyers who assumed South Carolina would always be cheaper. Investor saturation added volatility. Many homes were purchased as rentals, betting on endless population growth. In 2026, rents flattened while expenses didn't. Investors exiting at the same time accelerate price pressure. Rock Hill isn't collapsing because people don't want to live there. It's correcting because too many people paid future prices with yesterday's incomes. 4. Somerville, South Carolina, Charleston suburb. Somerville was one of the fastest growing suburbs in the entire Southeast. Proximity to Charleston, new master-planned communities, and strong marketing made it irresistible to transplants. But growth came with hidden risks. The first issue is infrastructure lag. Roads, drainage, and schools struggled to keep pace. Commutes lengthened. Flood concerns grew. Maintenance costs rose. These don't crash markets overnight, but they erode buyer confidence fast. Somerville is also heavily exposed to insurance volatility. As home values climbed, premiums followed. Flood insurance became a growing concern even outside traditional flood zones. Monthly housing costs jumped beyond what many households budgeted for. New construction oversupply is now unavoidable. Entire neighborhoods hit the market within a short time span. When resale sellers compete with builders offering rate buy-downs, prices bend downward. Tourism-linked employment adds risk. Charleston's economy is resilient, but sensitive. Any slowdown hits suburban demand first, especially among discretionary buyers. Investors who bought Somerville for appreciation are reassessing. Short-term rental regulations, insurance costs, and softer pricing are pushing exits. That adds supply at the worst possible time. In 2026, Somerville faces the downside of explosive growth. When affordability, insurance, and infrastructure collide, the market doesn't hold, it adjusts. 5. Concord, North Carolina, Charlotte suburb. Concord rode the Charlotte boom harder than almost any suburb. NASCAR, retail hubs, logistics jobs, and highway access turned it into a magnet for growth. But in 2026, Concord is feeling the downside of expansion built on thin margins. The first red flag is inventory buildup. Homes in Concord are taking longer to sell, and price reductions are becoming routine. During the boom, buyers were willing to overlook long commutes and cookie-cutter developments. That tolerance is gone. Concord's housing stock expanded rapidly, especially mid-priced single-family homes. When demand slows, homogeneous markets suffer first. Sellers can't differentiate, so they compete on price. That race to the bottom is already underway in certain subdivisions. Employment exposure matters here. Concord leans on logistics, retail, and service sector jobs. These sectors are cyclical and vulnerable in a slowdown. When overtime disappears or layoffs begin, buyers pause and renters double up. Property taxes and HOA fees quietly compound affordability issues. Many developments rely on HOAs to maintain sprawling infrastructure. As costs rise, monthly payments creep higher, even without price appreciation. Investor activity amplified volatility. Concord was popular with single-family rental investors chasing yield. In 2026, rent growth has stalled while maintenance, taxes, and insurance rise. Exits are starting, adding supply. Concord isn't crashing because it lacks jobs or amenities. It's correcting because it grew on momentum rather than fundamentals. When momentum stops, prices follow. 6. Indian Land, South Carolina. Charlotte Metro. Indian Land was marketed as the premium South Carolina alternative to Charlotte. Newer homes, better schools, and suburban polish. But premium pricing comes with premium risk. Home values in Indian Land surged faster than neighboring areas, pricing out many local buyers. The suburb became heavily dependent on high-income transplants. When corporate relocation slowed and remote work shifted, demand softened. Taxes are a growing concern. As valuations rose, so did property taxes. For buyers who crossed state lines expecting savings, the reality has been sobering. Insurance premiums followed suit, especially for newer, higher-value homes. New construction oversupply is now pressuring prices. Builders expanded aggressively, assuming continued inflows. Now incentives are everywhere. Rate buydowns, upgrades, closing credits. That drags down resale values fast. Indian Land also faces commuter risk. Many residents depend on Charlotte's white-collar job market. When those sectors stall, high-end suburbs feel it disproportionately. Investor exposure adds another layer. Some buyers treated Indian Land as an appreciation play rather than a long-term hold. As appreciation slows, those investors exit early, increasing inventory. Indian Land isn't unraveling overnight. It's deflating slowly, one price cut at a time. In housing, that kind of slow bleed is how suburban crashes begin. 7. Fort Mill, South Carolina, Charlotte Metro. Fort Mill has long been one of the crown jewels of the Charlotte Metro suburbs. With highly rated schools, sprawling residential developments, and quick access to downtown Charlotte, it became a favorite among families, professionals, and out-of-state buyers looking for stability in a rapidly growing region. However, 2026 has exposed vulnerabilities that weren't obvious during the boom years. The first major concern is overvaluation relative to local income. Home prices in Fort Mill skyrocketed over the last 5 years, outpacing the growth of household incomes. Many buyers stretched themselves to purchase homes during historically low interest rates. Today, with rates still elevated, affordability has dropped significantly. For many families, monthly mortgage payments now consume a larger portion of their income than is sustainable, reducing overall demand. Homes that once sold in weeks now sit on the market for months, with sellers reluctantly offering price reductions or incentives to attract buyers. The second pressure point is dependency on Charlotte's job market. Fort Mill thrives on its proximity to Charlotte's booming finance, tech, and corporate sectors. When layoffs occur or hiring slows, Fort Mill is among the first suburbs to feel the impact. Buyers delay purchases, inventories rise, and the ripple effect spreads to resale markets, where homeowners who hope to cash out find fewer interested buyers. Another factor is infrastructure strain and municipal costs. Rapid growth has put pressure on roads, schools, and utilities. Fort Mill has invested heavily to accommodate new residents, but these upgrades come at a cost: rising property taxes, HOA fees, and utility rates. Combined with inflated home prices, these additional costs deter potential buyers and strain existing households, especially middle-income families. New construction oversupply is compounding the situation. During the boom, developers raced to meet demand, building hundreds of new homes with similar layouts and pricing. As migration slows and demand softens, these homes are now competing directly with resale properties, pushing prices down. Builders have resorted to aggressive incentives such as rate buydowns, free upgrades, and closing cost assistance, which further erodes the value of nearby resale properties. Investor behavior is also shaping the market. Fort Mill attracted numerous single-family rental investors hoping for strong appreciation and rental yields. In 2026, rents have flattened while maintenance costs, insurance, and property taxes continue to rise. Investors who relied on appreciation for profits are now exiting the market, flooding it with inventory and accelerating downward pressure on prices. Finally, demographic shifts add another layer of risk. Some families are returning to Charlotte or relocating to other regions entirely, prioritizing lower taxes, cheaper insurance, or shorter commutes. Combined with inventory pressure, elevated costs, and slowing demand, Fort Mill's housing market is no longer immune to broader regional trends. In 2026, Fort Mill serves as a textbook example of how a high-demand suburb can transition into a fragile market. It isn't collapsing overnight, but the combination of overvaluation, job dependency, infrastructure costs, oversupply, and cautious investors has created a slow, steady deflation that could accelerate if market conditions worsen. 8. Waxhaw, North Carolina, Charlotte Metro. Waxhaw has become synonymous with suburban charm in the Charlotte region. Historic districts, large lot homes, excellent schools, and boutique shopping made it a magnet for families moving from across the southeast. Yet beneath this idyllic surface, Waxhaw is facing mounting pressures that could push its housing market toward a serious correction in 2026. The first major challenge is rapid appreciation outpacing incomes. Homes in Waxhaw doubled in value over the past decade, fueled by migration from larger metros and low interest rates. Median incomes have not kept pace with this growth, leaving potential buyers stretched thin. Elevated mortgage rates in 2026 exacerbate the problem, pricing many families out of the market entirely. Homes are no longer selling instantly, and price reductions are becoming increasingly common. Commuter dependence is another vulnerability. Waxhaw residents rely heavily on jobs in Charlotte, particularly in banking, tech, and professional services. Any slowdown in these sectors directly affects suburban demand. When layoffs or hiring freezes occur, potential buyers pause, homes linger on the market, and sellers must lower prices to compete. This dependency creates volatility in a market that previously felt insulated. Infrastructure and municipal costs contribute further risk. Rapid population growth strained local schools, roads, and public utilities. To keep pace, Waxhaw increased property taxes and HOA fees, adding hidden monthly costs for homeowners. These additional expenses, combined with inflated purchase prices, reduce affordability and deter buyers. Families that moved for a lower cost of living now find themselves paying more than expected. Oversupply of new construction is a critical factor. Developers built multiple large subdivisions in anticipation of continued migration. With demand slowing, these homes compete directly with existing listings. Builders offer incentives, rate reductions, free upgrades, and closing cost contributions to move inventory. This creates downward pressure on nearby resale homes, accelerating price corrections. Investor activity has amplified volatility in Waxhaw. Many investors purchased homes for short-term rental income or speculative appreciation. In 2026, rents have plateaued, and property expenses continue to climb. Investors exiting the market flood it with inventory, intensifying downward price pressure and reducing liquidity for other sellers. Finally, demographic shifts are compounding the risk. Families who once moved to Waxhaw for stability are reconsidering. Some relocate to smaller suburbs, other states, or areas with lower taxes and insurance premiums. When multiple households leave simultaneously, the market adjusts quickly, revealing its underlying fragility. Waxhaw is not in freefall, but its housing market is increasingly vulnerable. Overvaluation, commuter dependence, oversupply, investor exits, and hidden costs have created conditions for a slow, sustained correction. In 2026, Waxhaw is a prime example of a suburb that grew too fast and now faces the consequences of overextension. 9. Ballentine, North Carolina, Charlotte suburb. Ballentine has long been considered one of Charlotte's most desirable suburban enclaves. Luxury homes, gated communities, country clubs, and a reputation for upscale living drew affluent buyers from across the Carolinas and beyond. But in 2026, Ballentine's housing market is showing signs that even high-end suburbs are not immune to correction. The first red flag is rapid appreciation disconnected from local wage growth. Over the past decade, home prices in Ballentine soared, often outpacing increases in household incomes. Many buyers purchased with historically low interest rates, assuming appreciation would continue. With rates elevated in 2026, affordability has declined sharply. Buyers are pausing, homes remain on the market longer, and sellers are reluctantly offering incentives to attract interest. A second vulnerability is employment dependency on Charlotte's corporate sectors. Ballentine's buyer base relies heavily on finance, tech, and professional services jobs in the city. Any slowdown in hiring, wage freezes, or layoffs directly impacts demand. Even a minor economic dip ripples outward to suburbs like Ballentine, which depend on commuter-driven demand to sustain pricing. Oversupply of new construction has also exacerbated market fragility. During the housing boom, developers rapidly built luxury subdivisions, assuming continuous in-migration. Now, resale homes are competing with brand-new, incentivized properties. Builders offer rate buy-downs, upgrades, and other perks, which drives resale prices down and increases market volatility. Property taxes and HOA fees add hidden pressures. As valuations climbed, monthly costs increased. Families who stretched budgets to buy often find themselves financially constrained, making them more likely to list homes in a soft market. Investor activity further intensifies the issue. High-end investors who purchased homes for short-term appreciation or rentals now face flattening rents and rising maintenance costs. As some exit the market, inventory rises, further pressuring prices. Finally, demographic shifts amplify risk. Families and professionals increasingly consider alternative suburbs or states offering lower taxes, insurance, and commuting costs. When multiple households relocate simultaneously, the market reacts quickly, revealing underlying fragility. Ballentine is not collapsing overnight, but its market is deflating slowly. The combination of overvaluation, commuter dependency, oversupply, investor exits, and rising costs makes it increasingly vulnerable in 2026. Homeowners, buyers, and investors need to proceed with caution. This suburb's image of stability masks a slow, ongoing correction. 10. Mount Pleasant, South Carolina, Charleston suburb. Mount Pleasant has long been one of Charleston's most sought-after suburbs, known for waterfront communities, excellent schools, and a mix of historic charm and modern development. It attracted both locals and out-of-state buyers seeking high-quality living. But by 2026, Mount Pleasant is revealing the cracks beneath its polished surface. The first issue is skyrocketing home prices relative to income. During the boom years, buyers paid premiums expecting continued appreciation. In 2026, elevated interest rates and a slowdown in migration mean many households can no longer afford these prices. Inventory is growing, and sellers must increasingly lower prices or offer incentives to compete. Another factor is over-reliance on Charleston's economy. Mount Pleasant's desirability is tied to Charleston's employment in tourism, tech, logistics, and professional services. Economic slowdowns or disruptions, such as layoffs or hiring freezes, ripple into suburban housing markets. Buyer demand softens, homes linger on the market, and price adjustments follow. Rapid new construction is another vulnerability. Builders constructed numerous subdivisions in a short time frame, creating direct competition with existing homes. Incentives like free upgrades, closing cost contributions, and rate buy-downs are now standard, reducing resale value and pressuring older homes. Infrastructure strain is subtle but impactful. Roads, schools, and public utilities expanded during the boom, funded by property taxes and HOA fees. Rising monthly costs further limit affordability, especially for middle-income buyers or families stretched by high mortgage payments. Investor activity has added volatility. Many properties purchased for appreciation or short-term rentals no longer generate expected returns. With rents flattening and expenses rising, investors are exiting, increasing inventory, and accelerating downward pressure on home values. Finally, demographic changes contribute to risk. Families seeking lower taxes, cheaper insurance, or shorter commutes are considering other suburbs or out-of-state options. This movement compounds inventory pressure and softens prices further. Mount Pleasant is not collapsing overnight, but its market is under pressure. Overvaluation, commuter dependence, oversupply, rising costs, and cautious investor behavior combine to create a slow, steady deflation in housing values. By 2026, Mount Pleasant exemplifies how even prestigious, high-demand suburbs are vulnerable to market corrections when growth outpaces fundamentals. The Carolina suburban housing market in 2026 is sending a clear warning. From Fort Mill and Waxhaw to Ballentine and Mount Pleasant, the trends are consistent. Prices rising faster than incomes, oversupply in new construction, dependence on corporate job markets, and hidden costs like taxes, insurance, and infrastructure strain. These factors combine to create neighborhoods that look stable on the surface, but underneath, the market is quietly correcting. What makes this situation particularly dangerous is that many of these suburbs were marketed as safe or premium investments. Buyers came expecting endless appreciation, investors bet on rental income, and developers assumed migration would never slow. Now, elevated interest rates, slowed hiring, and cautious investor behavior are creating conditions for inventory to build, homes to linger on the market, and prices to adjust downward, sometimes faster than anyone expects. If you own property, are thinking of buying, or are investing in the Carolinas, knowledge is your most powerful tool. Understanding which suburbs are most at risk, and why, can protect your investment and help you make informed decisions. Ignoring the warning signs could cost thousands or even tens of thousands of dollars if a correction accelerates. Here's what you need to do right now. Hit the like button, subscribe, and turn on notifications so you never miss updates on housing trends and market shifts. Share this video with friends, family, or fellow investors who are considering a move to the Carolinas or who already own property there. The more people understand these trends early, the better prepared everyone can be. Comment below. Which Carolina suburb do you think is most at risk in 2026, and where would you move cautiously instead? Your insights might help others spot hidden risks before it's too late. Remember, these suburban markets aren't collapsing overnight. They're correcting slowly but steadily, and paying attention now can save money, stress, and future regret. Don't wait for headlines to tell you the story. Be ahead of the trend. The Carolina suburbs that looked like safe havens are changing fast, and your timing could make all the difference. Act now, stay informed, and keep your investments safe. Hit subscribe, share, and stay ahead of the housing market in 2026.